Meantime, is America seeing a capex comeback? Steve Liesman joining us along with Counselor to Treasury Secretary Scott Bessent, Joe Lavorgna. Steve, good morning to you, sir. Take it away.
Hey, good morning, Andrew. Thanks very much. Hey, Joe, thank you for joining us this morning.
Thank you, Steve. Thank you.
My first chance to interview you as the counselor to the Treasury Secretary there. Congrats on the job. Joe, walk us through what you're seeing, which is the first thing you did, you get into the job and you go down and dirty and start looking at the Fed's G17 industrial production report. So walk us through what you're seeing in terms of a capex boom that looks to be out there.
Sure, Steve. So the one thing we know that to get incomes up, to get middle-class wages higher, you need more capital. Capital ultimately will drive productivity, which gives you higher living standards and higher wages. So in the private sector, I used to always look at a very esoteric series called production of business equipment, and that's essentially your proxy for capex. And it rose 23% in the first quarter, and not surprisingly, the series in the GDP accounts rose 24%. And then I noticed in the second quarter, while there was going to be some inevitable slowing, that Fed data showed a near 11% increase. So what that meant is over the 2 quarters, we had about a 17% annualized gain in that Fed data, which tracks the capex and the GDP accounts super closely. That was the largest 2-quarter gain, Steve, since the last 2 quarters of 97, if you exclude the pandemic, which is really incredible. And you might say, well, why is that happening? Well, I would say the reason is because when the tax policy was extended with the One Big Beautiful Bill, it was retroactive to Inauguration Day, and what that encouraged and incentivized is companies to invest in capital, knowing that the bill ultimately would get done. So we're seeing the benefits of the capex boom early, and now that the law is official, I'm expecting the capex trajectory to remain very strong. That in turn will continue to foster, we think, upward pressure on the very powerful blue wages boom story, which is basically your non-supervisory production workers taking home bigger paychecks because they have more capital to operate with.
Joe, let me, I think this idea of it being linked to the Big Beautiful Bill has some potential to it, but I want to just throw out a couple offsetting factors on it and see how you respond to them. One is that there was indeed a pull forward on business equipment spending that had to do with people running ahead of the tariffs. Do you think that's a part of it as well?
No, I don't, Steve, because if you look within the GDP accounts, what you see is information processing and related equipment, which is all the AI, crypto, all that kind of newfangled technologies. That was the big driver. I mean, that was up over 70%. That was consistent with President Trump wanting to make the U.S. the crypto capital of the world. So the investment is occurring in the areas where it was supposed to be. And now I think, also, now that the bill is now final, I think you're going to start to see, Steve, a broadening out of spending elsewhere, because the bill also includes 100% expensing for plants and factories. So if you're going to build a data center, that's going to be very powerful if you're mining crypto, for example, to get that full expensing.
Well, it's interesting you bring that up, because I remember sitting with a bunch of CFOs at our CFO council. Maybe you'll come talk to it one day. But
I'd love to.
There were like eight folks around the table, and half of them were really excited about these things that you see coming, which is why I think there's some underlying truth to this idea that maybe they were anticipating the bill coming forward. The other half, though, were afraid of tariffs. I want to get you to talk about Japan in a second, but before that, is there a concern on your part that some of these tariffs may offset some of the business equipment that people need to bring in order to create the capex that you're talking about?
I don't think so, Steve, for a couple of reasons. One, I think most of us can agree that the tariffs certainly have not had the effect in terms of the price data that most economists had expected. And that, to me, reflects, Steve, the fact that the majority of the tariff has been absorbed in the margin. Yes, the importer technically pays that higher price, but the price coming in is offset by the increase in the tariff. We know the tariffs are being paid because we're getting record revenues. We could be $300 billion in the tariffs. But the inflation data so far has been de minimis, and I'm not certain that you're going to see really much of an inflation effect going forward, especially as you have energy costs and more capex, which tends to be disinflationary, offset any potential lingering or delayed effects from the tariffs.
All right, now I'm going to be accused of having buried the lead here, but give us your thoughts, Joe, on Japan and what it means for the economic outlook that this deal is struck, and what it tells you about, hey, maybe Europe is going to come along in some way, and China.
So as Secretary Bessent had said, the China-U.S. relationship is key. They're central to Asia, and the deal was done on very advantageous terms because President Trump worked to secure, an innovation fund, if you will, where the Japanese are going to commit over $500 billion, $550 billion to the U.S. So the deal was very innovative and structured as such. How everything else transpires, Steve, with other regions, I can't speak to that. Japan certainly did its part, and the president with Secretary Bessent, Ambassador Greer, and Secretary Lutnick really gave a great deal to the U.S. Now, that is now completed. So the market, which is anticipating these deals to come, as you know from looking at the equity market, which is close to all-time highs, record tights in credit markets, clearly the markets are voting with their feet and saying, look, we love this, we love these policies.
Joe, I always followed almost everything you wrote as a private sector forecaster. So I want to ask you, a lot of the administration's outlook on things like the deficit, overall economy, is based on a 3% growth number. How realistic is that?
Steve, the 1.8 number that the CBO has is just absurdly low. 3% to me is very doable for two reasons. Number one, in the first 3 years of President Trump's term, the economy grew 2.8% with very low and stable inflation. In the third year, growth was 3.4%. Given the fact that trend productivity, if you look at the productivity trend over the past several years, it began under Trump and it continued over the next 4 years, underlying productivity, Steve, is closer to 2%. Given where labor force is, I expect labor force participation to increase. The fact that there's no tax on overtime and tips and reduced tax cuts for seniors, those participation rates can rise. 3% to me is a very doable number, especially with the AI boom. I mean, it's really incredible what this can generate, and the payoff is much sooner. We're not going to wait decades for this capital investment to pay off. It's going to happen much more quickly. I think we're seeing it in our regular everyday lives, and therefore 3% seems to me a very doable number. And if that's the case, Steve, and you include the tariffs, you've got something counted like $4 trillion in extra money that the CBO didn't count when it did its last official forecast of the deficit back in January. So if we grow at 3%, the deficit's not going to be a problem. We're going to do a lot to grow our way out.
So what would you say, though, about a Federal Reserve, then, that is keeping rates unchanged or lowering them even just a bit in the face of 3% growth, which is quite a bit above where they think potential growth is, around 1.8 or 2%?
Yeah, I would say that, I've never been a big believer that too many jobs creates inflation, that, tight labor market does not generate inflation. Or in economic terms, they'll say the Phillips curve is flat, which to me is like there's no relationship between unemployment and inflation. What it could say is that if you look at the Fed's official forecasts in March, inflation's lower than where it was in March. We fast forward to June, those inflation forecasts, they revised up. Inflation was still lower than what they expected in June. We know that R-star is below where rates are at the moment. So if you're looking at, growth driving inflation, that to me is the wrong mental framework. And I do think there are people on the committee that have a very similar view. But by Jay Powell's own admission, interest rates are high relative to neutral.